Credit loss ratio (CLR) in financial institutions, analyzing the impact of credit loss on finance. Agenda overview. Introduction to credit loss ratio. Factors influencing credit loss ratio. Measuring and analyzing CLR. Impact of CLR on financial institutions. Strategies to manage and mitigate credit loss. Credit loss ratio. Credit loss ratio is calculated by dividing total credit losses by outstanding loans, providing insights into financial performance. Quality of loan portfolio. This ratio indicates the quality of a lender's loan portfolio, helping assess how well loans are managed. Exposure to risk. Higher credit loss ratio suggests greater exposure to risk, indicating potential issues in loan repayment. Importance of CLR in financial analysis, identifying potential losses. CLR assists institutions in recognizing potential financial losses, enabling proactive risk management and decision making. Loan loss reserves adequacy. Evaluating the adequacy of loan loss reserves is crucial for financial stability, and CLR plays a key role in this assessment. Assessing risk management strategies. CLR aids in assessing the effectiveness of risk management strategies, ensuring institutions are prepared for unforeseen financial challenges. Indicators of lending practices. A high CLR can signal poor lending practices or broader economic challenges, making it a critical metric for institutions. General formula and calculation. What is CLR? CLR stands for credit loss ratio, which measures the percentage of credit losses relative to outstanding loans. CLR calculation formula. Formula for CLR is calculated by dividing total credit losses by total outstanding loans, then multiplying by 100. Importance of CLR. Tracking CLR helps institutions monitor their loan performance and manage risk effectively over time. Factors influencing credit loss ratio. Economic conditions. Impact of economic conditions. Economic conditions like recession or inflation directly affect borrowers' capacity to repay loans, influencing financial health. Higher default rates. Adverse economic scenarios can lead to an increase in default rates, posing risks for lenders and financial institutions. CLR increase. An increase in default rates contributes to a higher CLR, credit loss reserve, financial institutions affecting profitability. Borrower creditworthiness. Importance of creditworthiness. Creditworthiness is essential for lenders to assess the risk of lending to borrowers and determining CLR effectively. Credit scores analysis. Analyzing credit scores provides insights into a borrower's credit history and their likelihood of repaying loans. Debt to income ratio. The debt to income ratio helps lenders understand borrowers' financial health and their ability to manage debt. Lending policies and practices impact on CLR. Lending policies and practices directly influence the credit loss ratio (CLR) of financial institutions. Underwriting standards. Strict underwriting standards help ensure that loans are granted to creditworthy borrowers, reducing potential losses. Risk assessment. Thorough risk assessments are essential for identifying potential risks associated with lending decisions. Measuring and analyzing CLR. Data collection and sources. Importance of accurate data. Accurate data collection is essential for reliable measurement of CLR in financial institutions, influencing decision making. Sources of data. Financial institutions use a variety of sources, including internal records and credit bureaus, to gather relevant data. Market analysis reports. Market analysis reports provide insights and trends that are critical for comprehensive data collection and CLR measurement. Methods of calculation. Direct calculation method. Direct calculation from loan portfolios involves analyzing each loan's details for accurate CLR assessment. Statistical models. Statistical models predict potential losses by analyzing historical data, providing a more comprehensive risk view. Importance of method selection. Choosing the appropriate calculation method is crucial to ensure accurate estimations of potential losses. Interpreting CLR results. Trend analysis. Analyzing trends over time helps in understanding the performance and direction of CLR results for informed decision making. Industry benchmarks. Comparing CLR results against industry benchmarks allows for assessing performance relative to peers and identifying areas for improvement. Risk management strategies. Evaluating the implications of CLR results is essential for developing effective risk management strategies to protect financial health. Impact of CLR on financial institutions. Risk management strategies. Establishing credit limits. Setting clear credit limits is essential for managing risk and preventing excessive credit losses in financial institutions. Diversifying loan portfolios. Diversification of loan portfolios helps mitigate risk by spreading exposure across various sectors and borrower types. Monitoring economic conditions. Continuous monitoring of economic conditions is crucial for adjusting risk management strategies and responding to changes effectively. Impact on profitability and financial stability. High CLR effects. A high credit loss rate, CLR, can negatively impact both profitability and overall financial stability of institutions. Balancing risk and return. Financial institutions must effectively balance risk and return to support sustainable growth and minimize potential credit losses. Sustainable growth strategies. Implementing strategies for sustainable growth can mitigate the adverse effects of high CLR and enhance financial stability. Regulatory and compliance considerations, CLR thresholds. Financial institutions must adhere to certain capital liquidity ratio thresholds set by regulatory bodies. Importance of compliance. Understanding regulatory requirements is vital for ensuring compliance and fostering investor confidence. Regulatory frameworks. Various regulatory frameworks govern financial institutions, and awareness of these is crucial for effective operation. Strategies to manage and mitigate credit loss. Effective credit risk assessment. Credit history evaluation. Evaluating borrowers' credit histories provides crucial insights into their past financial behavior and reliability. Financial standing assessment. Assessing the financial standing of borrowers involves examining income, assets, and liabilities to gauge their financial health. Repayment capacity evaluation. Understanding borrowers' repayment capacities is vital for predicting their ability to meet future financial obligations. Diversification of loan portfolio, risk reduction strategy. Diversification of a loan can significantly reduce overall risk by spreading exposure across different sectors. Economic stability. Diversified portfolio ensures that not all loans are impacted by the same economic conditions, maintaining stability. Sector variety. Including various sectors and borrower types in a loan portfolio promotes resilience and adaptability to market changes. Implementation of robust collection practices. Clear collection policies. Creating clear collection policies is essential for guiding financial institutions in their collection efforts and minimizing credit losses. Effective communication strategies. Employing effective communication strategies helps ensure that clients are informed and understand their obligations, reducing potential credit losses. Utilizing technology. Leveraging technology streamlines the collection process, making it more efficient and reducing overhead costs for financial institutions. Conclusion. Importance of credit loss ratio. Understanding credit loss ratio is essential for financial institutions to evaluate their credit risk exposure and make informed decisions. Influencing factors. Analyzing factors that influence the credit loss ratio helps institutions understand potential risks and impacts on their financial health. Effective management strategies. Adopting effective strategies allows institutions to manage credit loss and enhance overall financial stability in the long run. Thank you.